This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 30, 2026, and this is the Tokyo session. Now, let's get into it. It is 19:25 Eastern Time on Thursday, July 30, 2026. The global FX tape is vibrating with the aftershocks of a geopolitical shove. Treasury Secretary Bessent has openly endorsed yen intervention, triggering what headlines are calling the largest single hedge fund rout in history. The result? A fractured dollar, a surging kiwi, and a fear and greed index collapsed to a terminal 14. We are live on the edge of a policy cliff. Before we dissect the damage, let's look at the calendar. The clock is ticking toward three critical releases. First, the Bank of Japan's rate decision lands tonight at 3:00 UTC. This is the fuse we've been fearing. Second, right after the NY Open, we face a deluge of US data at 13:30 UTC, the PCE price index, weekly jobless claims, and the ISM manufacturing PMI. These numbers will tell us if the Fed can afford to ignore the yen chaos. Finally, on Friday, July 31, the Employment Cost Index hits the wire at 13:30 UTC. Apex set the scene for the BOJ decision.
The BOJ decision isn't just a rate hike, it's a collision course with Bessent's rhetoric. The market isn't looking for a dovish hold, it's pricing in a binary shark. If the BOJ tightens even slightly, the intervention threat becomes real. We aren't watching a monetary policy adjustment, we're watching for a liquidity event that could shatter the dollar-yen structure we've relied on for months.
Here is the snapshot as of 1925 ET. The Fear and Greed Index is deep in fearful territory at 14. The VIX is holding at 18.21, down slightly from yesterday, but well within the 5-day range of 16.64 to 20.31. In equities, we're seeing snapback rallies led by Amazon and Apple, but that's noise compared to the FX carnage. The dollar index is retreating 0.2% week over week to 120.71. Let's turn to the headlines driving this chaos. Pulse, give me the macro reality check.
The macro reality is simple. Policy divergence has gone nuclear. We have a Fed stuck with core PCE at 3.29% and a funds rate at 3.63%, while simultaneously, Treasury Secretary Bessent is signaling intervention in Tokyo. That contradiction is tearing apart the carry trade. Capital is fleeing yield-bearing assets. Look at the rotation. Aussie dollar and Kiwi dollar are up over 1% today. Why? Because the safe haven trade isn't just buying Swiss francs anymore. It's buying commodities that don't rely on the U.S. consumer. The sentiment isn't just fearful. It's desperate for an exit ramp from dollar longs.
And yet, gold is also participating. Gold is at 4,059.17. CIPHER, walk me through the institutional flow behind this rout. Let's process the breaking news moving these needles. Headline 1 from Forex Live. Did we just witness the largest single hedge fund rout of all time? Headline 2. Treasury Secretary Bessent appears to endorse yen intervention. And headline 4. Investing Live America's FX News wrap 30 JPY dollar yen moves sharply lower on speculation of intervention.
Those headlines are describing a liquidity vacuum. Look at the COT data. Leveraged funds added 97,394 contracts to yen longs in a single week. That is not a trend, that is a pile-up. We have a net long position of plus 1,209 for yen, but the change is the killer. When you add that much volume overnight, you create a fragility profile. Smart money, the asset managers, are actually increasing their DXY exposure by 22,196 contracts, while leveraged funds are dumping DXY by 7,100. The pros are hedging against the very move the speculators are chasing. The route you're hearing about is the mechanical unwinding of those 97K contracts. It's not organic demand. It's forced deleveraging.
So the pop in Aussie dollar isn't just strength, it's the absence of dollar dominance. Grid, where are the technicals standing?
Technically, dollar-yen at 163.5 is caught in a vice. The 5-day range is 163.213 to 163.951. Price is dead center. But here's the issue. The rejection off the 163.951 high shows immediate overhead resistance. On the flip side, Aussie dollar at 0.69523 is testing the structural integrity of its 5-day high at 0.70113. We are hovering just below parity. This isn't a breakout yet, it's a test. If Aussie dollar closes above 0.7, we validate the carry unwind. If it fails, we snap back. Meanwhile, cable at 1.33456 and euro dollar at 1.145 are both trading below their 5-day highs, confirming that the broad G10 uptrend is fracturing. The technicals are screaming consolidation, but the inventory risk grid mention makes that consolidation deadly.
We're going to dive into the 3 biggest movers: dollar yen, Aussie dollar, and gold. Let's start with the epicenter, dollar yen. It's at 163.5 plus 0.12% intraday. Grid, you called out the 163.213 support. Is that a floor?
It's a support zone, yes. The 5-day low is 163.213, but I'm challenging Pulse's view that this is a hard stop-loss cluster. Yes, Bessent's comments are scary, but look at the COT data CIPHER just cited. The leverage funds are net plus 1,209 bullish on yen. When price touches 163.213, you don't get a breakdown, you get a squeeze. Those shorts covering will push price back toward 163.5 or higher. Technically, this is a compression zone, not a cliff.
Grid, you're looking at price action and ignoring inventory risk. You think 163.213 is a magnetic support, with 97,394 new contracts dumped into yen longs last week. That level is a liquidity trap. There is no room for error. If Bessent's rhetoric holds weight, the move won't be a dip buy opportunity. It will be a margin call event. You don't need a technical breakdown when the counterparty vanishes. The squeeze you're predicting relies on buyers stepping in. At these volumes, there are no buyers left except the ones getting margin called.
Actually, CIPHER, I have to push back on the no buyers theory. The fear and greed index is at 14. That is capitulation. Usually when sentiment hits 14, the risk-off trade is exhausted. The fact that Aussie and Kiwi are surging means capital is finding refuge elsewhere. The yen-long squeeze might reverse if the BOJ doesn't act immediately. The market is pricing in action, and if the BOJ blinks, those 97K contracts become a burden, not a shield. The danger isn't the squeeze up, it's the stalemate down.
So we have a standoff. Grid, what happens if the stall continues? Does the pattern break?
If the stall continues, we get mean reversion. Dollar yen is trapped between 163.213 and 163.951. The 5-day range is narrowing. Historically, this compression leads to an explosive move, not a gradual drift. The key is the close. If we hold above 163.213 through the BOJ announcement, the technical structure validates a consolidation base. If we break below, we skip 163 entirely. My read is a hold because the 163.951 rejection was sharp and quick, suggesting sellers are hesitant at higher levels.
Hesitant? Grid, you're missing the volatility compression. The VIX dropped from 20.31 to 18.21. That is a dangerous artifact. Implied volatility is being suppressed while macro risk peaks. When VIX drops toward 18.21 while Bessent is threatening intervention, technical levels become irrelevant against the force of forced deleveraging. The floor at 163.213 will be vaporized by a volatility spike. You're treating this like a normal trading range. It's not. It's a coiled spring waiting for the BOJ clock to strike.
Okay, the risk is higher than the charts suggest. Let's move to the beneficiary, Aussie dollar. It's at 0.69523. Pulse, why is Kiwi and Aussie strength correlated?
Because they are both collateral damage of the dollar retreat. Look at the headlines. New highs for major indices. Snapback rally for the major indices. But specifically, the Kiwi dollar and the Aussie dollar are both up over 1% on the day. This is a diversification play. Investors are tired of the dollar-yen binary risk. They're moving into commodity currencies that have domestic catalysts. For Kiwi, we saw consumer confidence bounce to 99.3 from 91.3. That's a fundamental data point, not just sentiment. It gives the Kiwi intrinsic value protection against the dollar weakness. Aussie is riding the same wave, leveraging the broader risk-on snapback in equities, specifically tech like Amazon and Apple.
Be careful with the correlation pulse. Look at the flow for Aussie. Leveraged funds are still strongly bullish, net plus 24,788, but they reduced exposure by 2,434 contracts week over week. That is quiet accumulation, not a frantic rush. Contrast that with the yen data. The Aussie flow is stable, the yen flow is exploding. The rout is in the yen. The Aussie strength is a side effect, not the main event. Institutions aren't piling into Aussie because they love commodities right now. They're shorting dollar yen and using Aussie as a proxy because it's easier to execute. Don't confuse the vehicle with the destination.
CIPHER's observation on flow stability matches the chart. Aussie dollar is at 0.69523, approaching 0.7. The 5-day high is 0.70113. This is a classic breakout attempt, but notice the lack of wicks on the upside in the 5-day range. It's grinding up, not spiking. That aligns with the 2,434 contract reduction CIPHER noted. It's controlled, however. If we fail to hold above 0.7, we'll see a swift rejection back to 0.69223, the 5-day low. The technical structure supports a continued grind, provided dollar yen keeps wobbling near 163.5.
Controlled grind, okay. Final asset, gold. Gold is at 4,059.17, down 0.63% today. SPECTER, you flagged an anomaly here. Explain.
Right. Gold is trading at 4,059.17. The 5-day range is 3,995.98 to 4,116.61. Despite the minus 0.63% daily drop, price is holding firmly in the upper quartile. In a market with a 14/100 fear and greed score and a largest hedge fund rout headline, gold should be spiking vertically. Instead, it's chopping sideways near highs. This is a smart money accumulation signal. The daily dip is absorbing weak hands. The anomaly is that silver is at 57.54, lagging behind. Gold is decoupling from the equity snapback. While tech stocks rally, gold is silently building a fortress. The risk here is that if VIX expands beyond 20.31, gold stops holding and starts accelerating. We are in the quiet phase of the safe haven bid.
That's the synthesis. SPECTER identified the gold anomaly, CIPHER clarified the RC flow stability, and Grid mapped the RC dollar breakout potential. The picture is clear. We are not in a broad-based bull market. We are in a segmented unwind. Dollar yen is the fault line. RC dollar is the spillover. Gold is the vault. The common thread is the crowding of yen longs. As CIPHER noted, 97K contracts is unsustainable noise. As SPECTER warned, volatility suppression is a trap. And as Grid noted, technical levels are becoming secondary to liquidity gaps.
Let's summarize the key data points. Dollar yen is compressing at 163.5, caught between Bessent's rhetoric and the BOJ's upcoming decision. Aussie dollar is testing 0.7 on the back of NZ consumer confidence, bouncing to 99.3, but flows are cautious. Gold is holding 4,059.17, showing latent strength despite daily selling, and the VIX is dangerously compressed at 18.21. To wrap up tonight's Forex edition, the market is bracing for the BOJ decision at 3:00 UTC on July 30. Keep an eye on the 163.213 level in dollar yen. If it breaks, expect liquidity gaps. Watch Aussie dollar for a sustained break above 0.7, driven by domestic NZ data rather than pure carry trade speculation, and monitor gold's 4,059.17 level as a barometer for institutional fear. Tomorrow, July 31, keep your eyes on the employment cost index at 13:30 UTC and the ongoing US data stream. Stay sharp. This is ShadowQuant Forex edition, signing off. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.